Okay, this is day number 7 and video number 7 of 2025. And I just wanted to come here to give you a little bit of information on the 7th day that actually kind of wraps up this particular video series. And the question that I wanted to ask, or the statement that I wanted to make here is, I am afraid that the stock market is going to go down and that I'm going to lose money. This is a refrain that I hear about all the time. So I want to talk about that. I want to talk about some little tips about the stock market and how it works, as well as an analogy that I use to kind of help me through to get my psychology right about it. Now, to digress a little bit here, I just got back from a gathering and a gift exchange that I had with my fellow co-workers, the assistant managers and managers that work with me at my job. And for my gift on the gift exchange, I got a great gift that I'm just going to show you here. The book, The Millionaire Mission. See there, Millionaire Mission. It's by Brian Preston, who is the money guy. Now, I've talked about the money guy here quite a bit. And in fact, we went over there, the Financial Order of Operations. So I'm definitely going to be digging into that and reading that. So thank you very much, Diana, and the rest of the team for a great evening. Okay, let's jump into this, okay? Again, I talk to a lot of people who are afraid about what's going to happen to the stock market if it goes down. Now, I don't hear too much about it when it's going up. When it's going up, you know, there's euphoria and that sort of thing. But when it goes down, we go through a big psychology shift that is actually something that is detrimental to wealth building, okay? Because what happens is when the stock market goes down, the perception is that you're losing money. And when you feel like you're losing money, you're definitely going to have a fear. And what happens is that folks retreat from the stock market when really they should be doing the opposite. What Warren Buffett says is to be fearful when others are greedy, and to be greedy when others are fearful. And what that basically means is that the sweet spot, or when you're able to gain the most really, is when you're in the stock market, when the stock market's down, because you're buying good assets at a discount, okay? What I always do when the stock market goes down now is that I actually look around at what's going on. The last time that the stock market really had a dip was during the pandemic. And again, like I told you in the past, I work for a great grocery store, H-E-B, here in Texas. And during the pandemic, we were considered essential workers and we were serving everybody. And the store was busy. I mean, it was super busy. And what I saw is, even though the stock market was going down, I looked out around the store, and guess what people were doing? If you think about it, you probably can guess. They were walking around with these little devices. I have my device here. This is mine. They were typing on their devices and walking around the store. In fact, I saw a person typing on their device, and we were actually social distancing then, and they actually ended up bumping into the person next to them because they were paying so much attention to this device. And a lot of these devices, what is the company that has most people on this device, the cell phone that we deal with every single day? Well, it's Apple. And so even though the stock market was going down, I was seeing all of these people on their phones, which means that the Apple company was still successful, that it had value, that people were still using their phone. Yes, the stock market was down at that time, but it still had value. Another thing that I did was, when I was leaving the store, we have a Walmart across from us. And they are kind of our competition. But what it did was looking over there and seeing that the Walmart parking lot was packed, said to me that even though the stock was down with Walmart at that time, that Walmart still had value. A little bit further down the street from across the store that I work at is a McDonald's. And what I noticed during the pandemic was there was a line all the way out on the curb of the street where people were going through the drive-through to get their little McDonald's meal. So what did that say to me? That even though the stock was going down and the stock market was going through something with the pandemic as far as going through a dip, people were still interested in getting their Happy Meal or whatever they were getting from McDonald's. So that stock was still worth something. Okay? So it gets my psychology right, looking at that sort of thing during the pandemic. Let me walk you through a little scenario that I also find helpful for me as I'm thinking about the stock market. Let's say that you were going to go into the business of selling bread. What would you need to do first? You would need to stock up on some bread, right? Let's say that you were going to a wholesale bread place to buy your bread. So you went in there and you looked at the bread shelf that you were going to buy from, because you need to build up some inventory to sell at your bread shop. And you look at there and you see that the bread is $1 a loaf. And what you have is $100 to buy that bread, okay? So you look there, it's $1 a loaf, so you see that you can buy 100 loaves from this wholesaler. So you do that. You go ahead, you go up there, get your loaves, buy them, and go your merry way. You come back the next day to that wholesaler and you have another $100 to spend. Let's say that you have $100 daily. So you go back the next day and you're able to buy your 100 loaves of bread because they're still $1 each. Okay, let's say that you go back for the third day and you look on the shelf and you can't believe your fortune. You look on the shelf and the bread is 50 cents a loaf. You can't believe it, 50 cents a loaf. So rather than 100 loaves of bread, now you're able to buy 200 loaves of bread with your $100. You can't believe your fortune because why? You're gonna open a bread store in the future. So you're excited, you go get your 200 loaves of bread, you go pay for them and you go on your merry way. And you go back the next day and it's still 50 cents a loaf. And you just can't believe it. You're excited. You go get your bread and for your $100, you're able to get 200 loaves of bread. And it happens again on the next day for you. And you are just elated. You can't believe it. Then on the very next day, you go in and it's gone back up to $1 a loaf. But that's okay. You go ahead and get your 100 loaves of bread that day. And let's just say that now you have the bread to stock your store. So while you're getting your store together and you're getting your shelves together and you're getting everything cleaned up for your grand opening and you're going through that, and then finally opening day comes for your bread store. And what do you know? In the market, bread is selling for $2 a loaf. So not only did you buy it at $1 a loaf, but during that dip, you bought it at 50 cents a loaf. And now you're selling it later on for $2 a loaf. So you realize that profit. And if you can conceptualize that, if you got that story, that's kind of how the stock market works, okay? What is the best time to buy that bread? When it was $1 or when it was 50 cents? Of course, when it was 50 cents. That's when you're able to have the highest impact because later you're going to be selling that bread as a bread salesman. And so you got to get your mentality right about the stock market and about what we talked about, total stock market index fund or other index funds. Because when the market takes a dip and it goes through a downturn, that just means that is on sale, that you're getting these great companies at a discount. But again, it takes a difference in your psychology to get that and to take advantage of that. So I hope that these two tips help, okay? Another thing that I would highly recommend is that while you're calm and the market isn't going through a dip, that you start to think about your own risk tolerance. Now, it's helpful if you've been around a while and you've actually been in the market, maybe during a time like the pandemic. And so you're able to kind of take your temperature. How did you feel during the pandemic? Did you panic? Did you pull money out of the market during the pandemic? Well, that teaches you a lesson, okay? To tell you a little bit about myself, I've been around a while. So I also went through the 2008 financial crisis, where you had a crashing of the housing market, and you had problems with banks because they were giving these loans to people who had no business having a home loan. They basically gave home loan to person if they just had a pulse and showed up. They gave them a home loan, and then they took them and bundled them up and sold them in financial products for people to buy and invest in, and the system fell. Well, during that time, the stock market went through a crash, and at that time, I panicked, and I pulled money out. And I look back on that, and that was, because I made that decision, a loss of thousands. So definitely, you want to take your temperature. And if you're someone who gets kind of spooked by things like that from your experience, then I might look at adding some bonds, as we talked about, or treasury bills, or even CD ladders. I'm not going to go into the specifics of all of that, but in the real simple sense, like with the simple path to wealth, maybe you look at a total bond market fund and the total stock market fund, and you do some ratio of that. Maybe you do 20% total bond market, 80% total stock market. That way you have some bonds in the mix that are not as volatile as the total stock market, even though it's highly diversified and is not as volatile as one single stock or just a few stocks. With the total stock market, you have like 3,700 or closer to 4,000 companies that you're buying a little piece of. But you want to kind of look at that. What is your psychology like and your risk tolerance when the market goes down? And get a proper allocation going there, okay? Because the stock market does go up and down, but we know from history that since the inception that the stock market has performed in the 8 to 10% range, right in the really 10% range. So if history is any teacher for what will happen in the future, I like what one YouTuber that I watch says, that history does not necessarily repeat itself, but it rhymes. So we can make an assumption that what has happened in the past, that there will be a close approximation of that in the future. So you just want to look at that. Figure out what your allocation will be or what makes sense. The other tip that I would give you is to continue to educate yourself. Because educating yourself and learning about the stock market, just like that story I told you about the bread, or during the pandemic, taking a look at that people were still using their Apple phones, that McDonald's was still busy, that Walmart was still busy. That can help to get your psychology right to where you're in a position to where you can take a more healthy stance as far as risk is concerned. So you may be able to put more of your resources into the total stock market and be at ease as the market goes through its ups and downs. Here's the bottom line. You need to sleep well at night. Investing shouldn't be something to where your emotions rather are on the stock market roller coaster. So you're down when it goes down, you're elated when it goes up, and you're going up and down and up and down on this like a roller coaster ride. You don't want it to be like that. I almost say investing should be like watching paint dry on the wall or watching grass grow. It doesn't evoke emotion within you that causes you to make irrational, bad decisions. You want it to be very, very logical, that you've thought it through and you have a good plan when the stock market is up and when it's down, to ride it long term. Because I just got Millionaire Mission here at the gift exchange today. And what the money guy talks about, and that's Millionaire Mission, Brian Preston, the money guy, actually wrote the book. And what he talks about is it's like a yo-yo, okay? Yes, the stock market goes up and down. You've got that yo-yo. It's going up and down, up and down, up and down. But it's as if you're walking up, steadily up a mountain. So it goes up and down, up and down, up and down. But in the long run, it's doing what? It's going up. And so that's where you have to get your psychology right on this. And it's just a good tip as you're taking this journey with paper assets. And again, what J.L. Collins in The Simple Path to Wealth recommended was a total stock market index fund, so that you're buying the whole market and you're buying a little piece of all of the companies in the U.S. stock market. And you can relax with whatever mix you come up with. Now, I'll throw in another little tidbit as I close this out, okay? There are other funds that you might want to consider if you don't even want to think about managing two funds. You can just get one fund. And Brian Preston, the money guy, actually recommends this. They're called target date retirement funds. And what they do is that they start out more aggressive, like close to 100% total stock market. And over time, they become more conservative, adding more bonds, and maybe even cash equivalent like money markets to the mix as you get closer and closer to retirement. Let's say that you were using the company Vanguard, and you're 25 now, and you're going to retire at age 65. So that would be, it's 2025 now, it would be 2065 when you retire. 25, 35, 45, 55, 65, 40 years from now. So you would pick Vanguard's Target Retirement Date Fund 2065. And you don't even have to think about it after that. You just concentrate on getting your contribution to what they recommend, and what I think is a good benchmark is 25% of your gross income going into your retirement savings, okay? But with the target date retirement fund, all you have to do is put it in. It automatically takes care of becoming more conservative as you get closer to retirement. So you can kind of ignore all of the swings of the market and just concentrate on investing. Now, this is hopefully some tips that will help your psychology when it comes to investing, particularly in paper assets and very specifically into broad-based index funds. Again, I would like to thank you for listening, and good luck on your financial journey. We will see you, or I will see you, in the next video. Take care.